Real estate empires built by financial gurus are often romanticized as the result of bold bets, secret locations, or once-in-a-generation timing. But this surface narrative misses the deeper mechanics that actually created those empires. When you study the men and women who quietly accumulated vast property holdings over decades, you begin to see that real estate was never their first advantage. It was merely the medium through which their understanding of capital cycles, leverage, and human behavior expressed itself. Buildings were the outcome, not the strategy. The first thing financial gurus understood about real estate is that it is not primarily about property, but about control of cash flow over time. Unlike speculative assets, whose value depends entirely on future buyers, real estate can generate income while waiting. This single characteristic changes everything. It allows patience to be monetized. Gurus recognized early that the ability to hold through cycles is the true edge, and holding requires cash flow, conservative financing, and structures that do not force liquidation during stress. Most people fail in real estate, not because they buy the wrong location, but because they are forced sellers at the wrong time. Another defining trait is how these empires were built incrementally rather than explosively. Financial gurus rarely started with iconic assets. They began with unglamorous properties, small apartment buildings, secondary markets, mixed-use projects that others ignored. These assets were chosen not for prestige, but for asymmetry, limited downside, stable demand, and the ability to improve operations. By focusing on yield and operational control rather than appreciation, they allowed compounding to work quietly in the background, while competitors chased headline-grabbing deals. Leverage, often misunderstood, as recklessness, was treated by these individuals as a tool that demanded respect. They understood that leverage amplifies not intelligence, but fragility. As a result, they structured debt conservatively, favoring long maturities, fixed rates, and non-recourse terms when possible. The goal was never to maximize returns in good times, but to survive bad times intact. This conservative posture often made them appear overly cautious during booms, yet it positioned them perfectly to acquire distressed assets when cycles inevitably turned. Timing in their hands was less about prediction and more about readiness. Financial gurus did not attempt to call market tops or bottoms with precision. Instead, they prepared balance sheets for opportunity. They accumulated liquidity when prices were high, resisted the pressure to deploy capital aggressively, and waited for conditions where fear replaced optimism. When downturns arrived, they moved decisively, not because they were braver, but because they had preserved optionality, while others exhausted it. A critical but often overlooked element of their success was their understanding of local dynamics. While many investors chase macro trends, real estate rewards micro knowledge. Financial gurus immersed themselves in zoning laws, demographic shifts, infrastructure plans, and political incentives. They understood that a small regulatory change could be more valuable than a broad economic forecast. By aligning investments with inevitable local developments, they created value that appeared prescient, but was actually the result of deep, patient observation. Equally important was their approach to management. These empires were not built by passive ownership alone. Financial gurus treated property management as a core competency, not an afterthought. They standardized operations, invested in capable managers, and used data long before it became fashionable. This operational excellence stabilized cash flow, reduced volatility, and turned mediocre assets into reliable income machines. Over time, this reliability became a competitive advantage, allowing further expansion without proportional increases in risk. Their mindset toward scale was also distinctive. Growth was pursued only when complexity could be absorbed. Financial gurus understood that scale introduces fragility if systems are not ready. They expanded in waves, consolidating after each phase, refining processes, and strengthening governance before moving again. This rhythm of expansion and consolidation protected the empire from collapsing under its own weight, a fate that has ended many aggressive real estate fortunes. Another subtle factor was their relationship with reputation. In local real estate ecosystems, trust compounds. Financial gurus paid debts on time-honored agreements and treated partners fairly even when they had leverage. This reputation opened doors to off-market deals, favorable financing, and long-term partnerships unavailable to transactional players. Over decades, reputation became an invisible asset embedded in every acquisition. Perhaps most importantly, these individuals understood that real estate is a cyclical business, masquerading as a static one. Buildings look permanent, but values are not. Financial gurus respected this impermanence. They planned exits before entering stress-tested assumptions and assumed that today's favorable conditions would eventually reverse. This realism prevented complacency and kept their empires adaptable rather than brittle. What emerges from these patterns is a clear insight. Real estate empires were not built by chasing appreciation, but by engineering resilience. The gurus who succeeded did not attempt to outsmart the market daily. They structured their affairs so that time inflation and human necessity worked on their behalf. Housing, storage, commerce, and shelter are persistent needs, and by aligning capital with these needs through disciplined structures, they allowed wealth to accumulate almost quietly. And it is precisely here where most observers are tempted to reduce these empires, to buy low, sell high, that the deeper truth begins to surface, because what truly separated financial gurus was not deal selection alone, but the way they thought about ownership, debt, patience, and control. And once you begin to see real estate through this lens, the conversation must move beyond properties and locations into questions of temperament, restraint, and long-term stewardship, which leads us directly into the next phase of this exploration, where we examine how these empires survived, crises, generational transitions, and moments where everything built over decades was tested under extreme pressure. And it is exactly at this point, mid-thought and intentionally unresolved, that we need to continue as the sentence carries forward into the deeper examination of endurance, legacy, and the hidden costs of scale as the story moves on. And it is in moments of crisis that the true architecture of these real estate empires finally reveals itself, because prosperity can hide structural weakness for years, while stress exposes it within weeks. Financial gurus did not survive downturns by reacting faster than others, but by having already removed the need to react. Their portfolios were built with breathing room debt service coverage that assumed lower rents reserves that could absorb vacancies and legal structures that isolated failure, so that one mistake could not cascade into total collapse. During major downturns, whether caused by credit, freezes, interest rate shocks, or economic contraction, these empires shifted from expansion to preservation without panic. Gurus understood that the goal in crisis is not to be clever, but to remain solvent and credible. They cut discretionary spending, early communicated transparently with lenders and partners, and prioritized trust over optics. By doing so, they often secured flexibility precisely when others faced foreclosure, because lenders prefer cooperative borrowers to distressed adversaries. One of the most decisive advantages they held was psychological. Having studied cycles and lived through previous contractions, financial gurus were not shocked by downturns. They were prepared emotionally as well as financially. This emotional preparedness prevented rash decisions such as fire sales at the bottom or reckless refinancing under punitive terms. While competitors were paralyzed or frantic, these individuals remained methodical, reviewing each asset against long-term viability rather than short-term pain. As weaker operators failed, opportunities emerged. Distressed sales recapitalizations and forced partnerships created openings to acquire quality assets at fractions of replacement cost. Financial gurus did not rush blindly into these situations. They moved selectively, applying the same conservative underwriting that had guided them in good times. The difference was that prices now offered margins of safety unavailable during booms. Crisis for them was not a call to gamble, but a chance to rebalance the portfolio toward higher quality and lower basis. Generational transition presented a different kind of stress test. Real estate empires are particularly vulnerable when founders step back or pass on. Financial gurus who built enduring empires planned for this long before it became urgent. They invested in governance, succession planning, and education of the next generation. Roles were clarified, incentives aligned, and authority gradually transferred. This prevented the fragmentation and infighting that destroy many family-owned portfolios within a single generation. Another challenge emerged from scale itself. As portfolios grew, complexity increased. Gurus responded not by centralizing every decision, but by decentralizing operations within clear frameworks. Local managers were empowered within strict parameters, ensuring responsiveness without chaos. Systems replaced heroics. This institutionalization transformed personal empires into enduring organizations, capable of surviving beyond any single individual's presence. Over decades, regulatory and social pressures also evolved. Zoning changes, rent control, taxation, and shifting public sentiment toward landlords required adaptation. Financial gurus navigated these shifts by remaining engaged rather than defensive. They invested in compliance, community relationships, and long-term alignment with local stakeholders. By being seen as stable contributors rather than extractive owners, they reduced political risk and often overlooked threat to real estate wealth. Perhaps the most revealing test was temptation. As empires grew, opportunities to overextend multiplied. Cheap credit, enthusiastic partners, and flattering media attention created constant pressure to grow faster. Financial gurus resisted this pressure more often than they succumbed to it. They remembered that scale without control is not power, but vulnerability. Many of their most important decisions were refusals, projects not pursued, leverage not taken, markets not entered. In the final analysis, what allowed these real estate empires to endure was not brilliance in acquisition, but discipline in ownership. Financial gurus treated real estate as a long-duration commitment rather than a trading vehicle. They respected the slow nature of the asset class and aligned their expectations accordingly. By doing so, they allowed time, inflation, and human necessity to compound quietly in their favor. And so the story of these empires resolves not in dramatic exits or spectacular bets, but in continuity. Buildings remain, cash flows persist, organizations adapt, and wealth transfers across generations with less friction than one might expect. The real legacy is not square footage or valuation, but a way of thinking about ownership that balances ambition with restraint, growth with governance, and opportunity with responsibility. If this exploration has deepened your understanding of how lasting real estate wealth is actually built, I invite you to subscribe to the channel and continue these long-term reflections together, and leave a comment sharing which principle about resilience, leverage, or patience stood out to you most, because it is through reflection on enduring structures, not fleeting deals, that real insight into wealth creation is formed.